Trade receivable. So we are going to cover two subunits within this module: account receivables and note receivable. So let us first start with the account receivable. We all know for the last many years, account receivables basically are your customers. These are the amounts that customers owe to you for goods or services they have already received from us. So basically they represent oral promises to pay debts and are usually classified as a current asset because they are expected to pay you within 1 year. So we have two types of trade receivables. Trade receivables, these are the, of course, amounts owed by the customers who purchase the company's products or services. And for example, if a business sells goods on credit to a customer, the amount owed is classified as a trade receivable. And non-trade receivable, these are the amounts owed to the company that do not result from the sale of goods or services, like advances to employees, tax refunds, or amounts from other sources like loans. So they are called non-trade receivable. Then there is a very important concept called net realizable value, right? So net realizable, let me give you some numbers to explain the idea. Let's say I have a $100,000 worth of gross receivable, right? From this, I doubt that I may not be able to collect $5,000 from this amount. These are likely uncollectible receivables. Then we may offer some discounts to customer for early payment, let's say. And then likely sales returns and allowances. When customers return goods, we have to deduct the amount due from them. Let's say estimate is $2,000. So the net realizable value for our customers is the net figure that we expect to collect. So it is going to be $92,000. So this is a more realistic estimate of the actual amount of money that we will collect from our customers. Now, this one is a very useful format that I would recommend that you guys should memorize. It will help you find many unknown numbers while you are doing any questions or you are doing some simulation. So the format is that you have an opening debit balance. Clearly on trade receivables, we have a significant debit balance and sometimes a smaller figured credit balance, indicating that some of customers may have overpaid or customers with the credit balance. So you have an opening balance debit and an opening balance credit, tiny one. Credit sales increase your receivables. Refunds, when you make a refund, of course, you debit receivables, credit cash. Refund means some customers have overpaid. Interest on overdue account means some customers who delay the payments, we charge interest on such accounts. That is interest on overdue account. And if any customer who has paid us via check and check is dishonored for any reason, it appears on the debit side. So these are the four elements appearing on the debit side. What appears on the credit side? Collection from customers, any account receivable that has been written off, actual bad debts, actual customer going bad, return inwards, that is sales return, contra or set off means a customer also happens to be your supplier. So we net off the account. So the figure of contra appears here. And if we allow any discount to our customers, it appears on the credit side. And again, at the end, we will have a sizable debit balance and of course, some credit balance as well, in case some customers have a credit balance in their account. So this format is highly recommended. Memorize it and fill in the right numbers in the right locations when you're doing any question involving trade receivables and balance the accounts off. Any missing number you can find. Like maybe we want to find out the actual bad debts. Let's say all these numbers are available. So we can just balance the account off. The balancing figure here would be the actual bad debts written off. Next, we have valuation of account receivable with discounts. Okay, first of all, when a company offers a sales or cash discount, it means they are encouraging customers to pay earlier by offering a small percentage of the total amount if the payment is made within a certain time period. So this clearly would impact how account receivables are valued, because the amount expected to be collected can change whether depending upon whether they would like to take the advantage of discount or they don't like. For example, consider this first. Our company offers 210 net 30, which means a customer can get 2% discount if they pay within 10 days. If the customer doesn't pay within 10 days, then they will have to pay the full amount by 30th day. So we have two methods in this, gross method and net method. Let us discuss these one by one. The gross method would record the sales at the full price, no discount considered. Like if the customer pays within the discount period, a sales discount is used to reduce the revenue. For example, a company makes a sale of $1,000. They record the sale as $1,000. If the customer takes 2% discount and pays $980 within 10 days, in that case, that $20 is written as a sales discount, right? That's the gross method. What do you do in the net method? The net method assumes that the customer will take the discount and record the sales at the reduced amount. Like if the customer doesn't pay within the discount period, the company will record the missed discount as revenue later. For example, same example, a company sells good worth $1,000 but records the sales at $980, assuming the customer will take 2% discount. If the customer pays the full amount, $1,000, because they pay on 30th day, this $20 is treated as additional revenue. So these are the two methods under sales discount. One is gross and second is net. Okay, see another example, sales discount, gross and net method. Gaiety company sells $100,000 worth of goods to Smith company. The terms of the sale are 210 net 30, meaning if the customers pay within 10 days, we give 2% off, else full amount to be paid by 30th. Prepare the journal entries for account receivable. Gaiety company would record using both the gross method and the net method. So in the gross method, we will take the full amount of the sales. We debit account receivables and credit sales by $100,000. That's the gross method. But in the net method, we will deduct 2% off 2,000. That is 100,000 less 2,000, 98,000. So we debit receivable with 98,000, credit sales with 98. Let me show you. Gross, net. Now, if the customer pays within the discount period, the journal entries if the payment is received within the discount period. Since we have recorded gross, now we will consider the discount. Now we debit the net amount of cash, debit discount taken, and credit the gross receivable with full $100,000. But in case of net, since discount was already considered, the customer pays full net 98, so debit 98 cash, credit customer. Let me show you. So in the gross method, this is the discount now being considered, debit cash, discount, credit receivable. But in the net method, you simply debit cash, credit AR, because discount was already considered previously. And in case under the gross method, the customer doesn't avail the discount, he pays full amount on due date on 30th day, debit cash, credit account receivable. But in case when the customer here in the net method decides not to take the discount, rather pay the full amount or the due date, so in that is what we do, we debit cash, credit receivable to remove this 98, and then this 2,000 is credited as sales discount not taken. This is taken as a revenue. Trade discounts, we all know, these are the price reductions that are offered based on the quantity of items purchased. Meaning if a customer purchases a larger quantity, we provide trade discount. These discounts normally are given to encourage customers to buy more. So the key point here to note is that trade discounts, they are directly applied to price and are not recorded separately in accounting records. Basically, there is no accounting entry for trade records. However, they will reduce your sales, revenue, and account receivable. Like, for example, let me give you the number. Normally, we sell an item for $100, right? A customer comes and he orders 10,000 units, right? We offer a special price of $95, right? So it will not only reduce the sales revenue compared to 100 versus 95, it will also reduce your account receivable. That's the basic idea, right? So both sales revenue and account receivables are recorded after the discount is applied, meaning trade discount isn't recorded anywhere. We record the transaction net of trade discount. Then within trade discount, a concept you should remember is what you call the sequential discount. Means if there are multiple discounts, they are applied one after the other. Consider a customer is offered 10% trade discount on $1,000 original price. That means the discount will be $100, right? Now the company will record $900 sales, which is the net amount after the discount. Now, if there are multiple discounts like 10% and 5%, so first we are going to apply the first trade discount, which will be $100 above. And on the remaining amount, $900, we apply another discount, 5%, and that will reduce the price further by 45, so $855. This is the final sales price we will record in the company's book, right? So these are called sequential application or sequential discounts. Catlin and Brown sells coats with a list price of $1,000. They are sold to stores for list price minus trade discounts 40% and 10%. Calculate the Catlin Brown account receivables balance if 100 coats are sold on credit. So first, that's your list price. First, you apply 40% discount. That's the net price after the first 40% discount. And then again 10% discount. That's the net figure for your account receivable. And that's exactly what we discussed a little while ago. Estimating uncollectible accounts receivable. Okay. Now, we just discussed at the beginning of the class that your account receivable should be reported at their net realizable value. What it is, we discussed then. Let's say we have $100,000 account receivable. Since some customers may not pay their debts, so we must reduce the value by an estimate of uncollectible amounts. So the amount that you need to report as account receivable is NRV of receivable, the amount that you're likely to collect. So how do we bring about these uncollectible accounts, or the accounts which are not likely to be collected? So there are two methods. One is the direct write-off, other is the allowance method. Let us first discuss the direct write-off. First of all, this method is not acceptable for accounting under the US GAAP, right? So what we do in this method, we will only write off a bad debt when it is actually clear that the customer won't pay. We simply debit the bad debt expense and credit the customer. Actual bad debt. It is not permitted under the US GAAP. Why? Because this method does not match the bad debt expense to the revenue. Maybe because you might have sold goods in 2024 on credit. The actual bad debt occurred somewhere in 2026. So you are actually writing off the bad debt on 2026, effectively 2 years after the sale, right? So matching concept is violated, right? So that's why this method is not permitted under the US GAAP, because sale was reported in 2024. The bad debt related to this credit sale is being written off in 2026. So that clearly tells us that this is not acceptable because it violates matching principle. Another weakness of the system is that your account receivable will appear overstated on the balance sheet at the end of 31st December 2024, right? So this method doesn't give a realistic picture of what the company expects to collect. And moreover, this method is interestingly is used for federal tax purposes, because under the tax laws, you only write off a customer when it actually goes bad. But for US GAAP, no, this method is not acceptable for financial reporting under the US GAAP. Next, we have what you call the allowance method. That's what we're going to discuss in detail. Let's take an example first, direct write-off method. On December 15, year 1, Row Company recorded a credit sale of $10,000. On July 1st, year 2, the company determined that the account receivable was uncollectible. So prepare the journal entry. So you prepare the journal entry when the customer actually goes bad debt expense, debit, account receivable, credit. Now the issue is the revenue is reported in year 1, whereas bad debt is in year 2. So that's the issue. So revenue recorded in year 1 is not properly matched to the bad debt expense recorded in year 2. That is the issue with the direct write-off. Allowance method, that's the next one. First of all, this allowance method is a GAAP compliant way to account for your uncollectible account receivables, because it involves estimating how much of the company's receivables are likely to be uncollectible, and then accordingly making an estimate of expense and putting it in advance in our accounting system. So in this method, there is a key concept that you need to remember called current expected credit losses model. This means that companies need to estimate their expected losses on account receivables over their lifetime, not just when they actually default. So basically there is no strict formula for how companies should calculate expected losses. So you can take maybe your historical rates, that maybe on average 5% of your customers do not pay. You might use your industry average or customer regions or credit ratings, whatever the idea you might use. But the goal is that we want to set aside an allowance for potential losses before they happen. So for this, we create an account called the allowance for uncollectible accounts, sometimes called as the allowance for bad debts or provision for doubtful debts. There are many terms, but the term that used in US accounting literature is allowance for uncollectible account, right? It's a kind of contra asset account which we would use. And contra means it is netted with the gross figure. Let me tell you what basic idea is. Let's say your gross receivables are $103,000 and you made an estimate that based on some past historical averages that maybe out of this 5,000 may not be collectible. So this 5,000 is your estimate of bad debts. So you report $98,000 as your net receivables or NRV of receivables. And if there is an actual bad debt when a customer refuses to pay, like let's say a customer from whom we were expected to receive $2,500, he goes bankrupt or he just dies or this amount is gone, finished. So in that case, instead of charging this to income statement, we charge it against allowance. We debit allowance against this 5,000 and credit the customer that has gone bad. I will explain as we proceed. So how do we estimate the uncollectible accounts? There are two methods. One is the percentage of account receivable at the year end, which is also called the balance sheet approach. So in this method, a company would estimate that a certain percentage of its receivables will be uncollectible. Like we have $200,000 gross receivable at the end of the year. So we select a certain percentage based on the past experience, consider 5%. So out of this 200,000, 5% may not be collectible. So we will take this $10,000, 5%, $200,000 as an estimate bad debt, and we make an entry debit, income statement, credit, allowance for uncollectible accounts. All right, so that's the balance remaining in the books of account at 31st of December 2024. Next year, our sale was $250,000. Not sales, let's say next year our account receivables were $250,000. And keeping the same percentage, this year we need our allowance figure to be 5% of your trade receivable. Historically, we use 5%. So 5% of $250,000 would be $12,500. Assuming that the balance in allowance hasn't changed, let's say it stayed the same, right? So now this time we need $12,500 as the allowance figure for the current year. Already balance is $10,000 available. So the difference, $2,500, is the amount we're going to charge to income statement. Debit income statement, $2,500 allowance, $2,500 credit. So this $2,500 credit will add on to the existing balance and bring the balance to what we actually want the balance to be, $12,500. DF company uses percentage for uncollectible based on the year-end balance in account receivables. DF estimates that the balance in the allowance accounts must be 2% of the year-end account receivables of $80,000. The balance in allowance account already has a credit balance of $1,000 before any adjustment. Prepare the journal entry to record the adjustment to the allowance account at the year-end. See, $80,000 is the balance of receivables. We need 2%. That means we need $1,600 balance in our allowance. Since $1,000 balance is already available, so we need to make the entry for the differential. That's just what I told you. So you debit bad debt expense, that goes to income statement, credit allowance. This $600 credit adds on to $1,000, gives you the balance that what you want, right? If the $1,000 balance in the allowance account had been debit, we would have to bring it to $1,600. So in that case, we will create an allowance figure for $2,600. Please see what I'm telling you. If there is a debit balance in allowance, we want our allowance to have $1,600 balance. So in that case, first we need to remove this $1,000 debit and bring the balance to $1,600. So we are going to credit the allowance with $2,600. This way, this $2,600 credit will eliminate this $1,000 debit and restore the balance of $1,600. That's what we want as 2% of our receivables. So that's a very important point to be noted. Aging of receivables method. This is another method to estimate your uncollectible accounts by just categorizing your receivables based on how long they have been outstanding. Like Our current 10,000 receivable is just, we have sold goods to these guys, and then out of this total 25,667, 6,667 relates to those accounts which are only 31 to 61 days, and then 5,000 from 61 to 90 days, and over 90 days 4,000. So since older a customer balance is, there is more probability that they will go bad. So we expect that 20% of this amount may not be collectible, 10% of this amount will not be collectible, and 3% of this, and the amount that is currently due, means the current account receivable, only 1%. So that is a much better way, because it provides more detailed approach compared to a simple percentage of total receivable, because we categorize our receivable in different groups, and based upon this group we apply different percentage representing the likelihood that the amount may not be collectible, right? So this is the figure we want our allowance balance to be. So summarized from a form of analysis of individual invoices, the journal entry would be the same as that shown in the previous example. So the entries remain the same. It's just that the amount that we calculate, previously we calculated 1,600, which was the straightforward 2% of 80,000. But this time we have broken down our customers into different ages, and based upon that aging analysis, we have calculated this to be the figure for our uncollectible accounts. The key point here to be noted that the longer a receivable remains unpaid, the more likely it is to be uncollected, which is reflected in this percentage. That's the key point to be remembered. This is a very useful format. Please learn it by heart. If you learn it by heart, you will never get anything wrong. So ideally, your allowance for uncollectible accounts should have a credit balance, like the example. But sometimes if it may have a debit balance, right? Remember, then the entry you make, debit, bad debt expense, credit, allowance, and estimate of bad debt, it appears here, right? If any bad debt which was previously written off, it is recovered, it is not your income. If any bad debt which was previously written off is recovered, it is not income. Rather, you debit cash or bank, credit allowance with the bad debt recovered. And when a customer actually goes bad, the entry we make is you debit allowance for uncollectible account and credit that customer who has gone bad. Please note down, this is an extremely important format. Any question come across related to allowance, you can comfortably do this question. Please memorize this. Okay, so the customers to whom we have sold goods on credit, they might return some goods they don't need. So when they do, we debit sales return and pay them cash, or if cash hasn't been paid immediately, we credit account receivable, those customers that have returned. And of course, goods have come back to our warehouse, so we debit inventory, credit CGS, right? Jacobs Incorporated sells 500 in goods to Bennett, who pays in cash. The goods originally cost Jacob $350. 20% of the goods are returned by Bennett to Jacobs due to poor quality. Jacobs will record the following journal entries associated with the initial sale and the subsequent return. So, this is the original sale, debit cash, credit revenue, debit CGS, credit inventory, perfect. When the return is made, which is 20% of this amount, so you debit 20% of 500, that is 100, debit sales return, credit cash. And of course, if 20% of 500 is your selling price, then 20% of 350 would be your cost. So 20% of 350, 70, debit inventory, credit CGS, right? That's the explanation given right at the bottom of the slide. Write-off of a specific account receivable if a customer goes bad, won't pay. So we debit allowance, credit account receivable. This neither affects your income statement and it nor affects the net balance of your current assets. You can try, put numbers and you can see. So this completely bypasses your income statement, because allowance is being debited, which is not an income statement item. Account receivable, which is not an income statement item. So both of these will affect each other on the current asset side of the balance sheet, and net effect of these is zero. So your net current assets stay the same. Okay, now, what if subsequently we collect an account receivable which we previously wrote off? There are two possibilities. Either we're using direct write-off method. In this case, when we collect a customer who has gone bad and he subsequently pays us, we debit cash, credit uncollectible accounts recovered, which is an income account. It's a revenue account. But if you use allowance method, first you will restore your account receivable by debiting the account receivable, restore the account previously written off, debit account receivable, credit allowance for uncollectible accounts. And when the cash is collected, debit cash and close this account again, right? This way, this bad debt which is recovered after it was written off, it doesn't affect your income statement. Account receivable debit, allowance credit, cash debit, account receivable credit, it does not affect your income statement anyway. So the key point to remember, in the allowance method, when a customer is written off as bad debt, it does not affect your income statement. And when a customer who was previously written off is recovered, subsequent collection, again it does not affect your income statement. Pledging is when a company uses its account receivable as a collateral for a loan, like you have a $10,000 worth of account receivable and you pledge it as a collateral to a finance company, right? And when the money is actually collected from your customers, you will use this money to settle this loan with the finance company. The key point here to note is that your account receivable requires no entry, no adjustment, nothing. The only requirement is that you need to give a note in your disclosure to inform about pledged receivables, and nothing else is required. Next, we have factoring of account receivables. Factoring is different than pledging. Factoring occurs when a company sells its receivables to a factor. Basically, factor is a third party. It's a finance company that will pay you for these receivables. So what you do, you sell your receivables to get immediate cash instead of waiting for the customers to pay you. Factoring can be done in two ways: without recourse and with recourse. Without recourse means that you sell your receivables and the sale is final. Finish. The factor, the company that is buying your receivables, they are responsible. They assume all the risk of collecting the receivables. So if a customer doesn't pay, you are not worried. The factor cannot come back to you for the original amount of money due. They can't come for you for reimbursement. Like a company sells 10,000 in receivables to a factor without recourse. The factor itself is responsible for any losses if the customer doesn't pay. But if it is with recourse, that means the factor has the option to return uncollectible receivable to the seller. Like you sold 10,000 worth of customer, of this $500 went bad. The factor will come back to you for the recovery of this loss, right? For the transfer of receivables to be treated as a sale, there are some conditions to be met. Number one, the seller, the company that is selling its receivables, its obligation for uncollectible accounts must be reasonably estimated, mean the seller is responsible for those receivables. Second, the seller company must give up the control of future benefits of receivables. And third, the seller cannot be required to repurchase receivables. Like if the company has sold those receivables, they cannot be required to repurchase the receivables. Yes, but they can replace them with similar receivables, but they cannot be required to repurchase. So if these conditions are not met, the transaction is not considered as a sale, rather it is treated as a loan. Then we have the last topic under Unit 1, Accounts Receivable, securitization. Securitization occurs when a company transfers account receivable to another entity, like a trust. Consider two companies. Company A Incorporated bundles its receivables into a pool and sells this pool to a trust, which is another company, B Incorporated. Now this B Incorporated uses these receivables to issue securities, security 1, 2, and then these securities are sold to investors. So company A gets cash from company B for these receivables. Company B sells these securities collateralized against these receivables to investors, investor 1, investor 2, investor 3, 4, so on. And when these customers pay, from the collection of these customers, the company B will pay to its investors. All right, next topic we have note receivables. Note receivables are written promises to pay a certain amount of money, let's say $100,000 for 3 months at a certain rate, 5%. So basically they represent a formal agreement and to pay and to receive clearly. So if the period is less than 1 year, it is classified as a current asset, means if it's collectible within 1 year. And if it is collectible after more than 1 year, we classify it as a long-term asset. Now the issue we have is valuation and presentation. How do we value a note receivable? Let's say a note receivables of 3-month maturity with a 5% interest. We need to report it at the balance sheet date, like it's maturing at the end of March 31st, March 2025, and right now it's 31st of December 2024, right? So we are reporting it 3 months before it matures. So for accurate presentation in financial statements, the note receivables must be reported at its present value. This means we need to adjust factors like unearned interest, time value of money clearly. So let's say we have a bond, in fact a note, $10,000. So any unearned interest and finance charges, they are subtracted from the face value of the note to reflect the actual value that will be received over time. So basically to represent it at its present value. And let's say after our calculation, it comes out to be 9,350. We'll do an extended example to explain how this discounting is done. Just please hold on. The next we have is non-interest bearing or below market interest rate. Yes, if the note doesn't bear interest, or maybe it carries a rate lower than the market rate, like currently the rate is 5% of the market, but the bond bears 3%. Right now, this is an issue. The market rate is higher. Or maybe if it's a non-interest bearing note, then what we do? Now what we do is that we should use the market rate to adjust the note's value. So if it's an interest bearing note and it was issued under the normal circumstances like an arm's length transaction, so then it is presumed to be valued at the market rate of interest, so we don't need to make any adjustments. Adjustment is required when it is non-interest bearing or the rate is below the market interest rate. So that's what we make adjustment for. The final topic we have is discounting notes receivable. Discounting happens when a holder, like you, hold a note receivable, right? You are expecting amount in a certain period of time. Let's say you're expecting $100,000 in 3 months with interest at 5%. You can't wait, you need money urgently, so you sell this note to a third party, say X, in exchange for cash. Now, the issue is that what amount of cash you will receive. That's where discounting comes, because the bond will mature in 3 months, but you are getting cash against this note. I keep on saying bond, it's not. You're getting cash right now, so the cash that you are going to receive will be less than $100,000, because this is the maturity value of the bond, of the note, right? So we will apply a discount and we will find what amount you will receive now. So there are two ways to do it: with recourse, without recourse. Let's see the example in extended detail. Let's say you hold a note worth $10,000 maturity value, and you sell it to the third party for $9,500. This $500 is discount. We will see an extended example how is it calculated. So if it is with recourse, then you might still be responsible for $10,000 if the customer doesn't pay, the customer who wrote this note. So you would be responsible, so you will keep this liability on the balance sheet. But without recourse means that you are no longer responsible for $10,000 and you would remove it from the books entirely. Let us see an extended example that should explain the idea. Jordan Corporation has a $40,000 90-day note from a customer dated September 30th, year 3, due December 30th, year 3, after 90 days, and bearing interest rate at 12%. So what happens after a month? On 30th of October, year 3, 30 days after issue, and of course 60 days before maturity, Jordan Corporation takes the note to its bank, which is willing to discount it at 15%. The note was paid by Jordan's customer at maturity on December 30th, year 3, 60 days later. Compute the amount to be paid by the bank for the note after discounting and determine the amount that Jordan Corporation should report as net interest income from the note. There are certain steps involved. First, we are going to calculate the maturity value of the note by adding the interest to the face amount of the note as follows. Let me show you how it works. Now this is the face value of the note, and it bears an interest of 12%. So 12% interest on 40,000 for 90 days, because it's a 90-day note. So this 1200 added gives you the total payoff value of the note to be 41,200. So this is the first step. That's the maturity value. Face amount, face value plus the interest for 90 days, 41,200. That's the first step. Second step is to calculate the bank discount on the payoff value at maturity. Since there are 60 days to expiry, 60 days to maturity, so bank will discount it as per the question given, 15% discount rate. So we will discount this amount for 60 days at 15%. It's a very straightforward calculation. Let me show you. 41,200 times 15%, and for 60 days, 60 by 360. This is the bank discount. So what you will receive, 41,200 less 1,030. So the net of these two you will receive. Compute the amount paid by the bank, 41,200 less 1,030. So you receive 40,170 amount paid by the bank for the note. So we have done the first part, compute the amount to be paid by the bank for the note. Second part, determine the amount that Jordan Corporation should report as net interest income from the note. This is very straightforward. The face value is 40. What you receive is 40,170. The difference between the face value versus what you receive is the interest income. So determine the interest income or expense. Income would be if the amount paid is more than the face value, and expense would be if the amount paid is less than the face value. So that's the difference. 4170 is what you got, 40,000 was the face value, so this 170 is the interest income to Jordan Corporation. Dishonored discontinued notes receivable. Interesting. If a discounted note is dishonored, means the customer, the maker of the note, has failed to pay the amount due when it matures. So it is said to be a dishonored discounted note. So what do we do? What do we do in this case? So when a discounted note is dishonored, the company that originally held the note, it becomes liable again, assuming that it's a discounted with recourse. We discussed that. In case of with recourse, the company that held the note is responsible. So let's take some numbers. Company discounted a $10,000 note with recourse. This is applicable only in case of with recourse. So when you discounted, you got only $9,500 from a third party. If the customer who wrote this note fails to pay the $10,000 amount, then you become liable. To whom you sold, they come back to you because it is with recourse. So the company would reverse the contingent liability by debiting the note receivable discounted and crediting the notes receivable. So if you expect to receive only $8,000 from your customer, then you need to record a loss of face value versus what you got, $2,000 loss to be recognized.